I want to start with a simple question that sounds basic, but it changes how you invest. I want to start with a simple question that sounds basic, but it changes everything about how you invest, how you save, and how you see the world around you. For months, maybe even years, the dominant narrative has been one of economic anxiety. We hear it everywhere. Headlines scream about persistent inflation eating away at our savings. Pundits on financial news networks debate the Federal Reserve's every move, warning that rising interest rates could tip us into a recession. The cost of everyday essentials, from groceries to gasoline, has become a constant topic of conversation, a source of stress for millions. It feels like we're all bracing for impact, waiting for the other shoe to drop, but then you step outside. You look around, and the story the world tells you feels different. If the economy is truly so bad, why are airports not just busy, but absolutely overflowing? It's a sea of rolling suitcases and departure board scrambles, with flights booked solid months in advance, often at record-high prices. Why are the most sought-after restaurants in major cities booked out for weeks, sometimes months? It's not just about grabbing a quick bite, it's about the experience, the three-course meals, the celebratory dinners that don't seem to be slowing down. Why do luxury brands, from designer fashion to high-end automobiles, still have waiting lists for their most coveted products? These aren't just purchases. They're statements. And the demand for them seems remarkably resilient. And most tellingly, why are premium credit card companies, the very facilitators of this spending, still reporting incredibly strong, even record-breaking results quarter after quarter? The answer is that the contradiction itself is the story. The confusion you feel is the key. It's because the economy isn't one single monolithic entity anymore. It's multiple economies running in parallel at different speeds on different tracks, all at the same time. There's a fast lane and a slow lane, and they are diverging more dramatically than ever before. Understanding this divergence isn't just an academic exercise, it is the single most important variable for building wealth today. And today, we're going to use one powerful tool, a single company's earnings report, to decode this entire complex picture. Because American Express isn't just a credit card company, it's an economic sensor. It's a finely tuned instrument calibrated to the habits and health of a very specific and very influential slice of the global economy. When Amex reports its results, it's not just another data point. It's like getting a live, high-definition camera feed directly into the wallets of the world's affluent consumers. We get to see, with precise numbers, the real-time demand for travel and dining, the strength of luxury retail activity, and most importantly, the behavior of the consumer segment that, due to its wealth, drives a disproportionately huge share of total dollars spent in the economy. So when the news cycle is filled with stories of the squeezed consumer cutting back, and Amex simultaneously reports that its card members' spending is not only holding up but accelerating, that's not a random headline. That's a signal, a powerful, actionable signal that cuts through the noise. It's a signal that helps you understand what's real in this economy versus what's fragile. It helps you identify where the pockets of strength and growth truly are. And over the course of this journey, we will use this signal, and others like it, to build a complete framework. A framework for how to protect your capital, how to find opportunities, and, ultimately, how to build lasting wealth in a world where economic outcomes are splitting apart. This is your guide to navigating the two-track economy. And yes, we're turning this into a real wealth plan. Not doom, not hype. A step-by-step playbook. Quick note, this is educational, not financial advice. I'm sharing frameworks and examples so you can make your own decisions. So, let's break down exactly what the market heard from American Express. To understand the bigger picture, we first need to look closely at the details of their recent financial report. Amex reported its fourth quarter and full-year results, and the headline message was one of confident resilience. The company announced record-breaking full-year revenues, driven by a significant surge in overall spending on their cards. The big takeaway was this: spending from their core premium customers remains exceptionally strong. So strong, in fact, that the company felt comfortable projecting another year of robust growth, forecasting revenue to climb somewhere in the 9% to 11% range. This isn't just a minor detail, it's a powerful signal. In an environment where many are worried about a potential economic slowdown, Amex is telling the world that its high-earning, high-spending customer base is, for now, weathering the storm just fine. This points to a fascinating economic phenomenon that we'll explore in more detail later, the two-speed economy, where different consumer segments experience economic conditions in vastly different ways. However, the market's reaction wasn't pure celebration. The stock actually wobbled a bit immediately following the announcement. Why? Because beneath the strong headline numbers, there were nuances that gave some investors pause. A few key figures came in slightly under Wall Street's consensus expectations. More importantly, the company's expenses were noticeably higher. A significant portion of this increase was a direct result of a strategic choice. Amex is deliberately investing more money into its premium products. Think of the refreshed Platinum Card strategy, with its enhanced travel credits, lounge access, and exclusive perks. These benefits are expensive to provide, and that spending showed up on the balance sheet. Now, it's crucial to understand that this isn't inherently good or bad. It's a story about strategic positioning. The market's initial hesitation reflects a classic debate. The bearish view sees rising expenses and worries they could eat into future profits. The bullish view, which is the story Amex itself is telling, sees these costs as vital investments in building a deeper, more defensible relationship with the most valuable customers in the market. It's a calculated trade-off, sacrificing some short-term profit margin for what they believe will be greater long-term customer loyalty and sustained spending power. This isn't just about managing expenses, it's about building a moat. Through this report, Amex is sending a clear, unambiguous message to the market: we are doubling down on the high-end customer. This strategy permeates every facet of their business model. It means leaning into premium annual fees, which act as both a revenue source and a filter for committed customers. It means curating premium perks and exclusive experiences that can't be easily replicated, like access to sought-after events or unique travel benefits. It means investing heavily in premium customer service, ensuring that when their best clients call, they receive swift, effective support. And most importantly, it means cultivating a customer base that tends to spend more and more consistently through economic cycles than the average consumer. They are betting that this affluent segment will provide a stable and growing foundation, even if the broader economy faces headwinds. This is the core of their strategy, and it's the lens through which we need to view every piece of data that follows. And that's where the real economy part comes in, because if you're an investor, you don't ask, is spending up? You ask, who is spending up? And how durable is that spending? And which companies are positioned for that customer? That's the difference between watching headlines. Matching that or might be some balance. But matching then. Thinking like capital. Let's explain the two-speed economy in the simplest way possible. A two-speed economy means one part of the population is still doing fine, even thriving, because they have stable income, high skills, and often they own assets. They travel, they dine out, they buy premium services, they can absorb higher prices. Another part of the population is squeezed. They might have rising rent, rising insurance, rising groceries, higher debt costs, and not enough income growth to match it. So they cut back, they trade down, they delay purchases, they feel stressed. And this is why you can have a moment where consumer confidence feels weak, but spending still looks strong in certain categories, because different people are living different realities. So if your timeline is full of people saying, everything is expensive, nobody has money, and then you see packed airports, both things can be true, because the top end is still spending. Amex basically lives in that top end world, so their results are a window into that upper branch. And the investor lesson is, if you ignore the split, you get confused. If you understand the split, you can position intelligently. Here's a powerful concept. Markets respond to the marginal dollar. The marginal dollar is the next dollar being spent, invested, or saved. If the next dollar is being spent by wealthy consumers, companies tied to premium spending can keep growing, even if the average person is stressed. This is why you'll hear people say, it doesn't feel like a good economy, but the market is up. That's not magic, that's distribution. Asset owners benefit when markets rise. When asset owners feel richer, they spend more. When they spend more, premium businesses report strong earnings. When earnings are strong, markets can stay supported. That feedback loop is a huge part of modern economic behavior. But it also creates fragility. Because if asset prices drop or credit tightens, high-end spending can slow quickly. So you don't just want optimism. You want a plan that survives different climates. Let's talk about the Platinum strategy because it's not just a product, it's a statement. When a company raises a premium card fee to levels that make people say, that's crazy, they're making a bet that enough people exist who will happily pay it, and they will stay loyal for years. That's premiumization. Premiumization is when companies move up market, they charge more, offer more perks, and focus on higher value customers. Why do companies do this? Because higher value customers are often more stable, less price sensitive, and they tend to buy more over time. But premiumization also has risks. Competition gets intense, perks get expensive, and if the economy snaps, premium demand can drop. So when Amex invests heavily in premium refreshes, investors want proof. Is this driving durable customer growth, or is it just expensive marketing? This is exactly how you should think about any company you invest in. Are they buying growth, or building a moat? A moat means the business becomes harder to compete against over time. So here's what I'm going to do across these blocks. I'm going to turn this news story into a full system. We're going to cover 1. How to decode the premium economy signals, like Amex. 2. How to protect yourself from the downside branch, cash, debt, stability. 3. How to position for the upside branch, ownership, investing, skills. 4. How to avoid the traps that wipe people out, panic selling, lifestyle inflation, high interest debt. 5. A 12-month execution plan you can follow without being a finance nerd. And I'm doing it in a sponsor-safe way. Clear, evergreen, practical, no shock content, no reckless promises. Here's your first major takeaway. Stop asking, is the economy good or bad? Start asking, where is the money flowing? Who still has pricing power? Which customers are still confident? Which companies can protect margins? What changes if rates stay high? What changes if rates fall? These questions make you calm, because you stop getting emotional whiplash from headlines. You become an observer, a strategist. Think of the economy like 2 lanes. Lane A, the squeezed lane, higher debt stress, higher sensitivity to prices, more trade-down behavior, tighter monthly cash flow. Lane B, the premium lane, higher travel and dining spend, more willingness to pay for convenience, higher savings capacity, more asset ownership. Your goal is not to hate either lane. Your goal is to build a bridge from A to B. You do that through stability, cash buffer, debt control, ownership, investing, business equity, productive assets, skill growth, income expansion, patience, time in the market, not timing the market. We've talked about the big picture, the economic shifts, and the mindset of an owner. Now, let's make it practical right now. Let's bring it all home to your personal balance sheet. Because before you chase returns, before you try to outsmart the market, before you even think about complex investment strategies, you need a foundation. Think of it like building a skyscraper. You wouldn't start with the penthouse suite. You'd start by digging deep and pouring a massive concrete foundation. One strong enough to hold the weight of the entire structure through storms and tremors. Your financial life is no different. You need a foundation strong enough to hold volatility. Because if your personal finances are fragile, if you're living paycheck to paycheck with no buffer, any market dip feels like an emergency. A minor car repair becomes a crisis. A surprise medical bill becomes a catastrophe. And emergencies cause bad decisions. They trigger our fight-or-flight response, forcing us into short-term survival mode thinking. You might sell your investments at the absolute bottom of the market just to get cash. You might rack up high-interest credit card debt that takes years to pay off. Panic is the enemy of wealth, and a weak foundation is a breeding ground for panic. So we're going to build that foundation, brick by brick. It's not glamorous, but it's the most important work you'll do. There are 3 core pillars, so here's the basic foundation. Step 1, a cash buffer. We'll call this your emergency fund. Let's be crystal clear. Cash is not an investment. In an inflationary world, cash sitting in a checking account is losing purchasing power every single day, but that's not its job. The job of your emergency fund is not to make you rich. Its job is to keep you from becoming poor. Cash is your shock absorber. It's the financial firewall between you and life's inevitable chaos. It prevents you from selling investments at the worst time, locking in losses out of desperation. It prevents you from using credit cards as life support, digging a hole of high-interest debt that can feel impossible to escape. This fund should be liquid, meaning you can access it within a day or two, but not liquid. Keep it in a separate high-yield savings account, not your daily checking account. This creates a psychological barrier, forcing you to be intentional about using it only for true emergencies. So what are some simple targets? This isn't one size fits all, but here's a guide. Start with a goal of $1,000 or 1 month of essential living expenses. This is your starter fund. It's not meant to solve everything, but it gives you a small cushion, a moment to breathe when something goes wrong. Your next goal is 3 months of expenses. This is the point where you achieve real stability. A 3-month buffer can cover a significant unexpected event or a short-term job loss without derailing your entire financial plan. The gold standard is 6 months of expenses. This is especially crucial if your income is variable. If you're a freelancer, a commission-based salesperson, or you're building a business. This level of security gives you the freedom to make career moves, navigate economic downturns, and sleep soundly at night. Step 2. A bills system. This is about creating order from chaos. Most people lose control of their money because everything is mixed together in one big confusing pile. Your salary comes in and your rent, groceries, Netflix subscription, and savings contributions all come out of the same account. It's impossible to know where you truly stand. This lack of clarity is a major source of financial anxiety, so you separate money by purpose. This is the envelope system for the digital age. You create dedicated accounts for specific jobs. First, a bills account. This is for your fixed, non-negotiable costs. Rent or mortgage, utilities, insurance, and all minimum debt payments. Calculate the total for the month and make sure that amount is automatically transferred into this account on payday. This money is now untouchable for anything else. Your survival is secured. Second, a spending account. This is for your variable, flexible life. Gas, food, entertainment, coffee. This is the money you can spend guilt-free because you know your bills are already handled. And third, a wealth account. This is where your future is built. Money in this account is for investing, for your emergency fund, and for other major savings goals. Automate transfers to this account just like you do for your bills. Pay yourself first. Always. This system does something magical. When money is organized, your brain gets calm. You eliminate the constant low-grade stress of not knowing if you can afford something. You move from a state of reactive anxiety to proactive control. And that calm creates consistency, which is the secret ingredient to building long-term wealth. Step 3. A debt rule. This is about plugging the leaks in your financial boat. If you carry high-interest debt, like credit card balances or personal loans, you are paying a negative return every single month. A credit card with a 22% APR is a guaranteed 22% loss on that money, year after year. No investment strategy on earth can reliably outperform that kind of headwind. You are running a race with an anchor tied to your leg, so you build a payoff ladder to systematically eliminate it. Here's the framework. First, automate minimum payments on everything. This is non-negotiable. Missing payments destroys your credit score and adds fees, digging the hole deeper. Next you attack. There are 2 main strategies. The avalanche method is mathematically optimal. You throw every extra dollar at the debt with the highest interest rate first, while paying minimums on the rest. The snowball method is psychologically powerful. You attack the smallest balance first. Getting a quick win by eliminating one debt entirely can provide the motivation to keep going. Choose the one that works for you. Then, as you pay off one debt, you roll that entire payment, the minimum plus the extra you were paying, forward to the next target. This is the snowball effect that accelerates your progress. And the most important rule, don't add new debt while you're escaping. Switch to a debit card or cash. The goal is to drain the swamp, not just fight the alligators. Debt payoff is not punishment. It's not about austerity or deprivation. It's buying freedom. Every dollar of debt you eliminate is a piece of your future income that you reclaim for yourself. It's a direct, guaranteed return on your money, and it's the final pillar of a truly unshakable financial foundation. Now, investing. Most people want investing to be exciting, but wealth building is usually boring. The boring plan. Broad diversification, consistent contributions, rebalancing, long-time horizon, and the most important word, automatic. You don't decide to invest each month, you set it once. Then you let time do the heavy lifting, because here's the truth. Most investors don't fail because they picked the wrong fund. They fail because they panic, they overtrade, they chase, they stop. So your portfolio should be designed around one thing, what you can actually stick with. Let's tie it back. Amex is showing hooking points you can use to read the economy. Premium spending trends, travel and entertainment demand, the behavior of affluent and younger cohorts. and how companies reposition toward high-value customers. This tells you the modern economy rewards ownership, because the segment driving a big share of spending often overlaps with asset owners. So your mission is to become an asset owner, not overnight, not through gambling, through systems. Here's a mindset shift I want you to hear slowly. The rich don't just earn money, they organize money. They build a machine: income, surplus, assets, cash flow, reinvest, protect, repeat. And the reason this works is time. If you can keep the machine running for years, it starts to feel unfair. But it's not magic, it's structure. If you want to act like an investor in 2026, you need a dashboard, not 50 indicators, just a few that matter. 1. Credit stress trend, delinquencies, defaults. 2. Labor trend, unemployment direction, not headlines. 3. Inflation direction, especially essentials. 4. Corporate guidance tone, are companies confident or cautious? 5. Market concentration, are gains broad or only a few giants? Because in a two-speed economy, the turn can happen fast. You want early signals, not late panic. Let's make this interactive. I want you to pause and answer this honestly. Which lane are you in today? A or B, squeezed lane or premium lane? And then, what is one move you can make in the next 30 days that moves you closer to the owner lane? Maybe it's cutting one recurring expense, building a $500 buffer, paying off one small balance, setting up auto investing even if it's 25-week, learning one skill that increases your income. Small moves compound. In the next block, we'll go deeper into the actual numbers and what they reveal, what the guidance implies, what spending categories matter, why investors reacted, and how to separate temporary cost from durable moat. Because once you learn how to read an earnings story like this, you can do it for any company: banks, airlines, retail, tech, anything. If you're watching this and you want to build wealth without hype, you're in the right place. Block 2 is where we go from macro story to numbers plus strategy, and you'll see why this Amex report is basically a blueprint for what's happening in the premium economy. Again, educational only, not financial advice. Block 2. Decode the earnings like a pro, the 10-minute skill that makes you money for life. Alright, welcome to Block 2. In Block 1, we established our core thesis. The economy is undergoing a great divergence, splitting into two distinct lanes. On one side, you have the mass market, driven by price and necessity. On the other, you have the premium market, driven by quality, experience, and brand aspiration. We identified that premium spending isn't just a trend, it's one of the cleanest, most powerful signals of where durable wealth is being created and spent. It's a signal that cuts through the noise of day-to-day market volatility. Now, we're going to build on that foundation and learn the skill that separates headline investors from real investors. A headline investor sees a stock drop 10% after an earnings announcement and panics. They're driven by the dramatic headlines, the social media chatter, and the immediate price action. A real investor sees the same 10% drop, takes a breath, and asks one simple question: what does the data say? They look past the noise to find the signal. This block is about turning you into that real investor. We're going to decode the earnings report like a pro. In plain English, this isn't about becoming a certified accountant overnight. It's about understanding the universal language of business. Because whether a company sells luxury cars, high-end software, or premium coffee, they all speak in terms of revenue, costs, and profit. By learning to interpret these numbers, you gain a transferable skill you can apply to any company, not just company. Restore Jumpulir of the rest of your investing life, because when you master this, the entire dynamic of investing changes. You stop being scared of earnings season. Instead, you see it as an opportunity. You stop guessing what a company is worth and start calculating it. You stop reacting to the fear and greed amplified by social media noise, and you start making confident decisions based on the 4 pillars of fundamental analysis. These are the things that truly matter. First, cash, the lifeblood of any business. Second, growth, where the company is going. Third, risk, the potential threats to its success. And fourth, guidance, what management expects for the future. So here's the concrete goal of this block. By the end of our time here, you'll be able to look at a dense, confusing earnings headline like company EPS 353 versus 354 expected, revenue beats, expenses up, lowers full-year guidance, and you will instantly be able to answer 4 critical questions. 1. What actually changed in the business fundamentals? 2. Did the underlying business get stronger or weaker this quarter? 3. What is the market actually reacting to? The miss, the beat, or the guidance? And most importantly, 4. What does a smart, long-term investor do next? Do you buy, sell, or hold? And yes, we're going to connect every piece of this directly back to your personal wealth plan. This isn't just abstract theory. It's about how you use this knowledge to build real financial stability, how you invest consistently with conviction, and how you strategically position your portfolio to benefit from the growth of the premium economy, all without gambling or taking reckless risks. This is the bridge between understanding the market and building your own wealth. But before we dive in, our standard disclaimer. The information in this masterclass is for educational and informational purposes only, and does not constitute financial investment or legal advice. Always do your own research and consult with a qualified professional. Before we touch numbers, you need the 4 questions. Write these down, because this is the whole game. Question number 1, did the company grow? Question number 2, did the company get more profitable? Question number 3, did risk go up or down? Question number 4, what do they expect next? Most people only look at the first 2. Professionals always look at the last 2. Growth and profit tell you what happened. Risk and guidance tell you what could happen next. And that's why earnings move stocks. Now let's map those questions to the numbers that answer them. Let's start with EPS, because it's the headline that moves the market. EPS means earnings per share. It's basically profit divided by shares, so it's a per-share measure of how much the company earned. Company reported EPS around $3.53 in the quarter. Some expectations were around $3.54. That's a 1 cent difference, and people watching at home go, "Bro, 1 cent? Who cares?" But markets aren't reacting to the penny. Markets are reacting to what the penny represents. Was performance slightly below what the market expected? And more importantly, was the miss caused by something temporary or something structural? For example, if EPS is slightly lower because the company invested heavily in marketing, product refreshes, and customer engagement, that might be temporary. But if EPS is lower because spending is dropping, delinquencies are rising, and the business is losing pricing power, that's a bigger problem. So never stop at EPS. EPS is the doorway, not the room. Here's a simple rule. EPS is the what. The earnings report explains the why. Guidance tells you the what next. Now, revenue. For a payments.issuer business-like company, revenue is a mix of card fees, annual fees, merchant discount revenue, a cut of spend, net interest income, interest from revolving balances, and other fee streams. When revenue grows, it usually means some combination of power and more spending volume, more customers, and higher fees, higher loan balances, or better economics per transaction. In the report, revenue growth was strong, around 10% year over year for the quarter. This matters because revenue is the cleanest measure of demand. Costs can be managed, but demand tells you if people still want what you're selling. Now, here's how a pro thinks about revenue. Not is it up, but what kind of revenue is it? Because fee revenue is different from interest revenue. Fee revenue tends to be higher quality, more stable, and less sensitive to credit stress. Interest income can be strong, but it comes with risk. If delinquencies rise, those profits can get hit. So when you hear revenue up, you ask, is it mostly fees and spending volume, or is it mostly loan growth and interest? This matters in a high-rate world. Fees, quality, interest, risk, plus return. Now let's talk about the engine room of a premium card company. For a brand like this, the single most important heartbeat metric is what they call billed business, or more simply, total card member spending. This isn't about the number of cards in circulation, or the sheer volume of transactions. It's about the total dollar value of everything charged to those cards. Why is this the crucial figure? Because their entire business model, from merchant fees to card member rewards, is built on the size of these transactions. A higher billed business figure directly translates to higher revenue. It's the ultimate measure of customer engagement and the perceived value of the card itself. Think of it like a retail business. A discount store might focus on getting as many people through the door as possible, even if they only buy small items. But a luxury boutique thrives on high-value purchases. For them, one customer spending $10,000 is far more important than 100 customers spending $10 each. In this world, build business is the equivalent of the boutique's total sales receipts. If that number is growing, the business is healthy and vibrant. If it slows, it's a clear signal of trouble ahead. In their recent earnings report, company announced that build business grew in the high single digits. Now, in a slowing economy, that's a respectable number. But the real story is that spending occurred. The growth was particularly strong in what we can call premium discretionary categories: travel and entertainment, fine dining, high-end retail, and luxury goods. These aren't just random categories. They are the natural habitat for a premium cardholder. So why do these specific categories matter so much to an investor? Because they are powerful confidence categories. Think about your own spending habits. You don't book a 5-star international vacation or buy a designer watch if you're worried about your job or the economy. When people feel uncertain about the future, these are the first expenses they cut. They pull back on big-ticket items, delay aspirational purchases, and trade down to more affordable options. Spending in these areas is a direct reflection of economic optimism. Therefore, when you see strong, sustained spending in these premium categories, it sends a very clear signal. The affluent customer segment that drives the majority of this spending still feels financially secure and confident about their economic outlook. They aren't pulling back. This is a crucial piece of the puzzle. This observation connects directly to the broader macroeconomic theme of a two-speed, or K-shaped economy. It's a scenario where different segments of the population experience economic trends in vastly different ways. While many households may be tightening their belts, cutting back on non-essentials, and feeling the pinch of inflation, the high-end consumer continues to spend, seemingly unaffected. So as an investor decoding an earnings report, you don't just hear the headline, "Consumer spending is strong." You understand the nuance. You hear, "The premium lane of the economic highway is still moving at speed, even if the other lanes are slowing down." This tells you that the company's core customer base remains resilient. But a sophisticated investor doesn't stop there. This is where you apply a second layer of analysis. You have to look for the nuance within the spending data. Is this growth broad-based, or is it dangerously concentrated? For example, is the growth coming from across the premium and super premium cardholder base, or is it only the absolute highest-end customers carrying all the weight? Is spending strong only in travel, or are customers also using their cards for everyday purchases like groceries and gas? And critically, is this growth being fueled by acquiring new, high-spending customers, or is it just the same existing customers spending more, perhaps unsustainably? Answering these questions is how you distinguish between truly healthy, sustainable growth and what might be fragile, late-cycle behavior. Healthy growth is broad and diverse. Late-cycle behavior is often narrow and concentrated, a final burst of spending before a potential downturn. Getting this distinction right is key to assessing the true quality of the company's earnings and its resilience moving forward. Welcome back. In this section, we're tackling what is often the most misunderstood and, frankly, the most debated line item in any earnings report: expenses. When investors see expenses rise, the knee-jerk reaction is often negative. It can pressure metrics like earnings per share, and, on the surface, it looks like a company is becoming less efficient. But is that the whole story? Not even close. To truly understand a company's health and strategy, you have to learn to look at expenses not just as a cost, but as a strategic choice. Let's dig into companies' recent numbers to see this in action. Now let's talk about the thing that likely pressured EPS, expenses. In the last quarter, companies' total expenses rose around 10% year over year to roughly $14.5 billion. For a company of this size, that's a significant increase, and it immediately raises a critical question for any investor. Why? Where is that money going? For a premium consumer, finance, business-like company, expenses aren't just corporate waste or bloated overhead. A huge portion of these costs are variable and directly tied to growth and customer engagement. Think about it. These are what we call growth expenses. They include things like marketing campaigns to attract new high-spending members, customer acquisition costs, which are the bonuses paid out for new signups, the cost of rewards and perks, which scales directly with how much customers use their cards. Servicing costs, because premium members expect a higher level of support. And finally, product refreshes, which involve significant investment in technology and design. This is why, counterintuitively, in the premium card space, costs can actually rise when business is strong. It's a sign of momentum. When people are spending more, the company's reward costs naturally go up. When you launch a major card refresh, marketing spend spikes to build awareness. When you add valuable new perks like travel credits or exclusive access, your operating costs rise. These aren't leaks in the boat, they're the fuel for the engine. So, an expense increase is not automatically bad news. The critical question an investor must ask is this: are these costs strategic investments that will generate future returns, or are they just a leak in the bucket? This is where you need to put on your hat as a business owner. If you run a small business and you spend $1,000 on a targeted marketing campaign and it brings in new customers who generate $5,000 in profit over the next year, that's a fantastic use of capital. That's good spending. But if you spend that same $1,000 on an unfocused campaign that produces zero new business, that's bad spending. It was a leak. Professional investors on Wall Street are doing the exact same analysis, just at a much larger scale. They're looking at that $14.5 billion in quarterly expenses and asking, is the company using this capital to buy sustainable growth and build a competitive moat, or is it just spending more to stand still? So let's frame the central question. Are these expenses an investment or macroeconomic? Now here's the part most casual observers miss, especially in the premium market. The perks, the service, the rewards, they aren't just costs. They are powerful tools for creating sticky customers. And sticky customers are the holy grail of any subscription-style business. They produce incredible lifetime value because they stay longer, reducing churn. They spend more on the platform year after year. They become brand advocates and refer their friends. They are more likely to upgrade to higher-tier products. Over time, they become a predictable, high-margin, recurring cash flow stream. So, an expensive product refresh that costs hundreds of millions of dollars can be an incredible investment if it increases customer retention by even a few percentage points and boosts average spend. The long-term payoff can be many times the initial cost. But this strategy also creates a significant risk, and this is what makes the market nervous. If the expensive refresh fails to attract meaningful new accounts or increase engagement from existing ones, you haven't bought growth. You've just permanently raised your cost base. Gangasit sir, the das nam shoot skyinger jasigori durdoburi, with den dao jots in copter, our danger verdring. Or for ram for our future profit margins. This is the very heart of the debate you see among analysts after an earnings report. They are all trying to determine if the company is getting traction from its spending. Is the investment paying off? And here's the key takeaway for a savvy investor. You don't have to win the argument on earnings day. In fact, you shouldn't even try. The smart move is to step back, listen to both sides of the debate, and then watch the data over the next 1 or 2 quarters for confirmation. The numbers will tell you who was right. So what are you watching for? Here's a checklist you can screenshot. These are the key metrics that will confirm if the spending was a wise investment. You're looking for an acceleration in new premium account growth, high and stable customer retention rates, a clear increase in spend per customer, growth in fee revenue from annual memberships, and crucially, stable credit performance, ensuring they're not buying growth by lowering lending standards. If you see strength across these metrics in the following quarters, you can be confident the expenses were an investment. If they are flat or weakening, the expenses were a leak. Now we get to risk. If you invest in anything connected to consumer credit, you must understand credit quality, because credit quality can flip a great quarter into a problem fast. The key indicators: delinquency trends, net charge-offs, provisions for credit losses, and don't sell them reserve levels. You don't need to be an accountant, you just need to understand the direction. If provisions for credit losses spike, that usually means management expects more defaults. If charge-offs rise, it means defaults are happening. If delinquencies rise, it means stress is building. Now, company is different from a mass market lender. It tends to have a premium customer base. That often means better credit performance. But you still watch it, because if the economy shifts, it will show in the data. This is why a 2-speed economy matters. Even if premium customers are fine, stress can rise elsewhere in the system, changing sentiment and regulation. So, here's how you connect micro and macro. Premium spending can stay strong, while broader consumer stress rises. which can still affect markets and policy, and that's why you diversify. You don't want your entire portfolio tied to one consumer outcome. Let's talk about revolving balances and loans. When outstanding loans grow, net interest income often grows too. That can boost profitability, but this is where you need judgment. Loan growth is not automatically good. Loan growth is good when it's coming from healthy spending, customers can pay, credit losses stay stable. Loan growth is dangerous when it's coming from people using cards to survive, minimum payments rise, delinquencies trend up. So as an investor, you ask, is loan growth a sign of strength or strain? Premium issuers often argue it's strength. In a tight economy, some borrowers use credit to bridge gaps. That's strain. The truth can be both, depending on segment. So you never look at loan growth alone. You look at loan growth plus credit losses together. Now, card fees. Annual fees are powerful because they're recurring, they're predictable, and they're tied to customer willingness to pay for value. When a company raises fees and customers stay, that's pricing power. That's one of the best qualities in investing. So when company pushes a premium card strategy, you watch fee revenue growth and customer retention. If fee revenue rises and churn stays low, the premium bet is working. Now bring this back to your personal wealth. Pricing power is not just a business concept, it's a personal concept too. If your income is tied to a skill with pricing power, you're less vulnerable. If your income has no pricing power, you feel inflation more. That's why building skills is part of wealth. Now the big one, guidance. Guidance is management saying what they expect next year. Revenue growth, earnings range, and the drivers behind it. Company guided to roughly 9 to 10% revenue growth and EPS in a range like $17.30, $17.90 for 2026. That tells you, management expects demand to stay strong enough to keep growing. Now here's how to interpret guidance like a pro. Step 1. Compare guidance to consensus expectations. If guidance is above expectations, it's a positive surprise. If it's below, it can be a negative surprise. Step 2. Ask what assumptions are embedded. Is guidance assuming steady employment, stable credit losses, continued travel demand, no major regulatory changes? You don't need exact assumptions in that son. You don't spy. You need to know what could break it. Step 3. Spy. Watch the tone. Earnings calls have confidence language. If executives sound cautious, they may be seeing softness. If they sound strong, they may be seeing resilience. So here's the truth. Guidance is not a promise. It's a forecast. And it can change fast. So you never go all in on guidance. You use it to understand the base case. Then, you diversify for other scenarios. Now, capital return. When a company raises its dividend, it signals confidence in cash flows. Company announced a dividend increase, about 16% to $0.95 per share quarterly. That's a major signal. They believe earnings are durable enough to commit to higher payouts. Now, some people hear dividends and think that's for old investors. Wrong. Dividends are part of total return, and consistent dividends often correlate with quality businesses. But the real lesson is, when a company returns capital, it's telling you, well, we don't need every dollar to survive or invest, we can share it, but that's strength. However, you still care about valuation. A great company can be a bad buy at the wrong price, so you don't chase because of a dividend raise. You incorporate it into a long-term plan. For most people, the best plan is still automate investing, diversify, hold long-term, reinvest where appropriate, rebalance. Now let's address the confusing part. Why would the stock dip if revenue beat and spending was strong? 3 common reasons. Reason number 1, expectations were already high. If a stock ran up before earnings, the market may have priced in a perfect report. Anything less than perfect leads to sell the news. Reason number 2, costs rose. Even if costs are investments, the market may demand proof they pay off. Reason number 3, macro, policy risk. Even hints of regulation, rate changes, or consumer slowdown can pressure the sector. So don't treat a one-day move as truth, treat it as pricing. Markets are auctions. Prices move based on what buyers and sellers believe right now. Long-term wealth isn't built by reacting to every auction moment. It's built by owning productive assets over time. Let me give you a checklist you can copy. Earnings decode. Checklist: 1. Revenue growth, up or down. 2. Spend billings, up or down. 3. Fee revenue, up or down. 4. Interest income, up or down. 5. Expenses, up or down, and why. 6. Credit losses, stable or rising. 7. Guidance, stronger or weaker than expected. 8. Capital return, dividends, buybacks. 9. Competitive position, strengthening or weakening. 10. Risks mentioned, regulation, rates, consumer softness. If you can answer these, you are already ahead of most people. Now, I want to convert this into action. Here are your next 3 moves. Move. Number 1. Build your personal credit resilience. Even if premium spending stays strong, stress can rise elsewhere. So build a cash buffer, reduce high-interest debt, keep your credit clean. Avoid lifestyle inflation. Move number 2. Automate ownership. Set an auto-invest schedule that matches your life, weekly or monthly. Small is fine, consistency is the point. Move. Number 3. Learn one pricing power skill. Pick one skill lane powers from skill. Sales, analytics, project management, technical skill, operations, something that increases your income stability and surplus. Because the two-speed economy rewards people with surplus. Surplus becomes assets. Assets become freedom. In the next block, we're going deeper into premiumization and pricing power. Why companies are shifting upscale, which industries benefit, what the risks are, and how you invest in that theme without gambling. Because the smartest investors don't chase hot stocks. They understand durable forces, like premiumization, and they build systematic exposure. If you're still here, you're doing it right. You're building skill, not just getting motivation. Drop a comment. What part of earnings confuses you the most? EPS, revenue, expenses, or guidance? And I'll tailor the next blocks to answer it. Business inquiries. Danilo Incarnation, prav908@gmail.com.
Let me hit you with a truth most people don't want to hear, but it's the key to investing in 2026. The world is getting more expensive. On purpose. Not because one company is evil. Not because there's some secret meeting. But because the market is learning something. The biggest profits come from the customers who can pay more and complain less. That's the premium economy. And American Express is one of the clearest examples of it. In Block 2, we learned how to read earnings like a pro. Now we're going deeper into the strategy underneath the numbers. Premiumization. To truly understand premiumization, we have to start with the why. This isn't just a fleeting trend or a simple marketing tactic. It's a fundamental, structural shift in the economy, a deliberate strategy that smart companies are using to navigate a complex new landscape. Premiumization happens when 3 powerful forces show up at the same time, creating a perfect storm that changes how businesses compete and win. Force number 1. The customer base splits. The idea of an average consumer is disappearing. Instead, we see a great divergence. Some people are squeezed by inflation and stagnant wages, forced to cut back and hunt for bargains. Their discretionary spending is shrinking. Some people are stable, managing to keep up but feeling cautious. And then, some people are thriving. Their wealth has grown from assets, their incomes are rising, and they have more spending power than ever. For a business, targeting the average is now a recipe for failure. You end up with a product that's too expensive for the squeezed group and not good enough for the thriving one. So companies stop thinking average customer. They start thinking best customer. They pivot to serve the segment with growing wallets and a willingness to pay for quality. Force number 2. Costs rise and margins get pressured. This is the reality for nearly every business today. When labor, logistics, marketing, and input costs all rise, profit margins get squeezed from every direction. A company has 2 choices: absorb the costs and watch profits vanish, or pass them on. But you can only pass on costs if your customers let you. This is where pricing power becomes a company's most valuable asset. The best defense against inflation isn't just cutting costs. It's building a brand so strong and a product so desirable that your customers will happily pay more. That is pricing power. Force. Number 3. The market rewards stability. In a volatile world, investors crave predictability. They pay higher valuations for companies with durable, recurring profits. And where do those durable profits come from? They come from loyal, high-value customers who aren't spooked by economic cycles and can easily afford price increases. These customers provide a stable revenue stream that insulates a company from recessions. So premiumization is not just raise prices. It's a comprehensive strategy to build a fortress-like business. It's about cultivating a customer base that can fund future growth, withstand economic cycles, and keep spending, no matter what the headlines say. Now connect that to the Amex story. Amex is the quintessential example of this strategy in action. The company is literally built around the core idea that a premium customer is worth exponentially more. Their entire model is designed to capture this value. They can generate high annual fees, which create a predictable, recurring revenue stream, incredibly high spend per card member driving transaction revenue, and often better credit performance than the mass market, reducing risk. So when Amex talks about strong spending in travel, dining, and luxury categories, they're not just reading data. They're describing the premium lane of the economy, the lane where their customers live and spend. And when they raise the platinum annual fee to nearly $700 and add perks, that's not random. That's a pricing power test in real time. It's them asking, how strong is our brand? How sticky is our customer base? How much value do people assign to status, service, and exclusive experiences? And the fact that they can do that, while still attracting a new generation of younger, affluent consumers, is the ultimate proof of the premiumization thesis. It shows that this isn't just about serving the old guard, it's about capturing the aspirational spending of tomorrow's wealthy. Now let's define pricing power the way investors actually use it. Pricing power means a company can raise prices without losing demand, not raise prices and lose half their customers. Raise prices and customers still show up. In investing, pricing power tends to create stable or rising profit margins, resilience during inflation, and stronger long-term compounding. Because here's what people miss. Revenue growth is good, but if your costs rise faster than revenue, your business can still struggle. Pricing power is how you protect the spread between revenue and costs. That spread is called margin, and margin is a huge driver of stock performance over time. So when you hear premiumization, you should translate it into, this company is trying to increase pricing power. But there's another layer. Premiumization is also about customer psychology. Because premium customers don't just buy utility, they buy convenience, trust, status, identity, experiences, and time saving. And those are hard to compete against. If a company wins the identity and experience layer, it can charge more with less resistance. That's why premium brands often feel unfair. They're not just selling a product, they're selling an emotional outcome. And investors want exposure to that, because emotional outcomes are sticky. Let's use Amex as a case study because it's clean and obvious. Amex reported strong spending among affluent and younger customers. They even highlighted that spending by Gen Z and millennials has become larger than Gen X for the first time, which is a huge signal about who the future premium customer might be. Now, why is that important? Because if younger cohorts are willing to pay for premium perks and experiences, that means premiumization could be durable for years. Think about what premiumization looks like for a 25-year-old professional. They may not buy a huge house yet, but they'll pay for travel, dining, experiences, lifestyle subscriptions, convenience services, and premium branding. That's why experiential spending is so important. It's not just stuff, it's identity and life. So Amex pushing premium perks is a bet that experiences remain a priority, and high earners keep spending. Now, there's also a risk. Premiumization often depends on confidence. If confidence drops sharply, job losses, recession, major market decline, premium spending can slow. That's why smart investing is not bet all your money on one theme. Smart investing is build broad exposure, then tilt carefully. Let me show you how to spot premiumization in real life, because once you see it, you can't unsee it. 1. Airlines. Premium cabins expand. More premium economy. More first-class experiences. More loyalty benefits. Even if the plane is the same, the pricing and segmentation get sharper. 2. Hotels. More resort fees. More experience packages. More loyalty tiers. More partner perks. 3. Restaurants. Fewer items. Higher prices. More fixed menus. More reservation exclusivity. More upscale positioning. 4. Retail. Luxury brands remain strong while middle brands struggle. Discount retailers can also do well because trade down happens. The middle can get squeezed. 5. Subscriptions. Basic tier, plus tier, premium tier. The premium tier has the best features, and the company pushes you toward it. 6. Finance. Premium cards, premium banking, wealth management. Higher fees justified by service and perks. This is a segmentation game. Companies are building ladders. They want you to step up the ladder as you earn more. And they want to keep the top customers forever. Premiumization is basically build the ladder, protect the top rung.
Now let's talk like investors. This means we need to move beyond simply observing the trend of premiumization and start analyzing its structural impact on the market. We're putting on our analytical hats to identify the fundamental characteristics that allow certain companies to thrive in this environment while others get left behind. It's about understanding the underlying mechanics of business models and identifying which ones have the durability to not just survive, but prosper when customers are willing to pay more for perceived value. So, if premiumization is a durable, long-term trend, who are the predictable winners? Winner type number 1, companies with strong brands. A powerful brand is one of the most durable competitive advantages a company can have. It acts as a mental shortcut for consumers, signaling quality, trust, and status. This deep-seated trust is what reduces price sensitivity. When a customer believes in a brand, they're not just buying a product, they're buying an assurance of quality and a feeling of belonging. This emotional connection builds incredible loyalty, making customers less likely to switch to a competitor, even if that competitor offers a lower price. Ultimately, this translates directly into pricing power. A strong brand can raise prices incrementally over time without losing its customer base, leading to healthier margins and more predictable revenue streams. Winner type number 2, companies with high-income customers. This is a straightforward but powerful advantage. If your core customer base is affluent, your revenue is naturally more insulated from the bumps of the economic cycle. These consumers have significant discretionary income, meaning their spending on non-essential goods and services isn't as tightly tethered to factors like gas prices or modest increases in interest rates. Their financial stability allows them to continue purchasing premium products even when the broader economy feels uncertain. This doesn't mean these companies are entirely recession-proof, but their demand is far more resilient and less fragile than businesses serving customers with tighter budgets. Winner type number 3, companies selling experiences and convenience. In an increasingly commoditized world, experiences stand out. It's very difficult to compare shop for a unique memory or a feeling of delight. This inherent differentiation gives companies that sell experiences, like curated travel, exclusive events, or high-end dining, a natural defense against price wars. Similarly, convenience has become a modern form of luxury. Time is our most finite resource. If a company can save its customers time and reduce friction in their daily lives, those customers are often willing to pay a significant premium. Think of services that offer seamless delivery, automated subscriptions, or intuitive user interfaces. Convenience is addictive, and once it becomes part of a customer's routine, they will tolerate price increases to maintain it. Winner. Type number 4, companies with network effects or switching costs. This is about creating a sticky ecosystem. If a product or service becomes more valuable as more people use it, that's a network effect. Think of social media platforms or business software. The more your colleagues or friends are on it, the harder it is for you to leave. Similarly, high switching costs lock customers in. This could be the hassle of transferring all your data to a new cloud provider, learning a new software interface, or losing loyalty points with an airline. When it's difficult or costly for a customer to switch, the company gains the power to raise prices with a much lower risk of churn. Winner type number 5. Companies with operating leverage. This is a key financial characteristic that investors love. Operating leverage occurs when a company can increase its revenue without a proportional increase in its costs. Software companies are a classic example. The cost to serve the millionth customer is nearly zero. Premiumization supercharges this effect. By increasing the revenue per customer through higher prices or upselling, companies with high operating leverage can see their profits expand dramatically. A 10% increase in price might not just lead to a 10% increase in profit, it could lead to a 30% or 40% increase, as that extra revenue drops almost directly to the bottom line. Now, on the flip side, who tends to struggle in this environment? Loser type Store 1. Middle market no identity brands. This is the danger zone. If you're not known for being the cheapest, and you're not recognized as being the best, you risk becoming invisible. In a premiumizing world, customers polarize. Those feeling the financial pinch trade down to the lowest cost option. Those with more spending power trade up to brands that offer better quality, status, or experience. The middle gets squeezed from both sides, facing a battle for relevance and a slow erosion of market share. Loser type number 2. Companies competing only on price. If your only competitive advantage is being cheaper than everyone else, your business model is inherently fragile. Your margins are perpetually at risk from rising input costs, supply chain disruptions, or a new competitor willing to lose money to gain market share. While you might win a large volume of customers, the profits can be so thin that there's no room for error. This strategy is a constant, exhausting race to the bottom. Loser type. Number 3. Companies with weak balance sheets. Successfully navigating the premiumization trend isn't free. It requires significant and sustained investment in marketing to build a brand, in R&D to improve product design, and in operations to enhance service and customer experience. Companies burdened with high debt or low cash reserves simply can't afford to make these crucial investments. They are forced to stand still while their better capitalized competitors pull further ahead, widening the gap. Loser type number 4. Businesses exposed to the most financially stressed consumers. This is the direct counterpoint to the high-income customer advantage. If your primary customers are living paycheck to paycheck, their spending is highly sensitive to inflation and interest rates. When the cost of essentials like food, rent, and gas goes up, their discretionary spending is the first thing to go. Demand for your products can fall off a cliff when economic conditions tighten, making revenue highly volatile and unpredictable. Now, I want to be very careful here. This framework is an economic analysis, not a moral statement. This isn't about saying poor people lose, rich people win. It is an objective description of how publicly traded companies, which are legally obligated to maximize shareholder value, adapt their strategies to optimize for profit in a given economic environment. Understanding these mechanics is crucial for making informed investment decisions. So what is the actionable lesson for you, personally? It's that you cannot rely solely on your wages to build wealth in this environment. The path to financial resilience is to build two things in parallel: personal stability through budgeting and saving, and ownership exposure through investing. You need to participate in the upside of these successful business models, not just be a consumer of them. You don't just work for a wage, you build assets that work for you.
Now we arrive at the most important question. How do you actually invest in the premiumization theme without turning your portfolio into a high-stakes casino? It's a seductive idea, this concept of identifying a massive, unstoppable trend. The temptation is to go all in, believing you found a sure thing. But in investing, the moment you think you found a sure thing is the moment you should be most cautious. Because the single biggest mistake investors make, time and time again, is this. They hear a compelling theme, they get swept up in the story, and then they chase a single stock. They fall in love with a brand or a product and convince themselves that this one company is the only way to play the trend. This isn't investing, it's speculation. It's betting on one horse to win the race. And that is an incredibly risky strategy. Even if you are 100% right about the premiumization theme, that single stock can still fail to deliver, or worse, lose you money. Why? The company's success might already be priced in, meaning its valuation is too high and there's no room left to grow. The management team could disappoint on execution, failing to capitalize on their opportunity. Fierce competition could suddenly intensify, eroding the very pricing power you were betting on. Unexpected regulation could hit the industry, changing the rules of the game overnight. Or the broader economic cycle could simply turn, and a recession could impact even the most resilient luxury brands. Any one of these factors can derail a great company. So, let's build a safer, more durable framework. It starts with a non-negotiable foundation. Step 1. Core first. Before you even think about a theme, your portfolio's core must be established. This isn't the exciting part, but it's the most critical. Your core should not depend on any single theme, country, or company. It should be built on broad, global market exposure. Think of it as owning the entire haystack, not searching for the one needle. This is your bedrock of stability. Why is this so important? Because the winners in the premiumization space today might not be the winners tomorrow. New innovators will emerge, and consumer tastes will shift. A broad market index is designed to automatically capture that rotation over time, selling the laggards and buying the new leaders for you. Your core portfolio does the heavy lifting, ensuring you participate in overall economic growth, no matter which specific companies are in favor. Step 2. Add a small tilt, not a giant bet. Once your core is solidly in place, you can then consider expressing a view. If you believe in the premiumization theme, you can add exposure, but treat it as a tilt, a smaller, strategic slice of your portfolio that complements your core. This is your satellite, not your planet. The key is to size it appropriately so that if your thesis is wrong, it won't destroy your financial plan. Step 3. Focus on quality as a proxy for pricing power. Instead of trying to guess the next hot luxury brand, a much safer approach is to use quality as a filter. High-quality companies are the ones that often possess the durable pricing power we're looking for. They typically have strong, defensible profit margins, robust balance sheets with little debt, consistent and predictable cash flow, and a loyal customer base that creates durable demand. Investing in a basket of these high-quality businesses is a much more reliable way to express the premiumization theme. Step 4. Diversify across the premium stack. Remember, premiumization isn't just about expensive handbags or watches. It's a broad-based phenomenon. It shows up in premium credit cards and payment networks, in business-class travel and luxury hotels, in high-end enterprise software services, and in specialized private healthcare. By diversifying your thematic tilt across these different sectors, you reduce your dependence on any single industry and protect yourself from isolated downturns. Step 5. Automate and rebalance. Finally, put the system on autopilot. Automation, like setting up recurring investments, removes emotion from the equation and prevents you from trying to time the market. And periodic rebalancing is your defense against chasing winners. It forces you to trim the positions that have grown too large and reinvest in the areas that are lagging, maintaining your intended allocation and enforcing discipline. So, if you're a long-term investor, the simplest and most effective version of this entire framework is a large, diversified core, a small, quality-focused tilt, and a consistent, automated process. This strategy allows you to participate in a powerful theme without taking on gambler's risk. For the vast majority of investors, a simple, elegant, and disciplined approach like this is all that's needed to build wealth successfully over the long run. Now let's be mature and talk about what can break the premiumization story, because every theme has a risk. Risk number 1, a sharp labor market shock. If unemployment rises meaningfully, even premium spending can slow. Not immediately, but it can. Risk number 2, credit tightening. If banks tighten underwriting, credit availability drops, spending can slow. Risk number 3, a big market drawdown. If asset prices fall, affluent confidence can drop, which can reduce discretionary spending. Risk number 4, competition and perk inflation. Premium cards can turn into an arms race. More perks, more marketing, more costs. If the economics don't work, margins can compress. Risk number 5, regulatory pressure. If policy targets fees, interest rates, or practices, it can change the business model. This is why you don't build wealth on perfect conditions. You build wealth on resilience. A resilient investor holds a cash buffer personally, has diversified investments, avoids high-interest debt, and invests on schedule through cycles. The goal is survival first, then compounding. Now, I want to translate premiumization into personal wealth. Premiumization in your life means you become harder to replace. You gain pricing power. If you work a job where your skills are generic, your pricing power is weak. If you build a skill stack where you're valuable, your pricing power grows. That is how you move into the premium lane financially. So here are the 3 personal steps. Step 1, increase your surplus. Surplus is what you have left after necessities. Surplus is the fuel for assets. If you have no surplus, you can't build wealth. So you start by controlling expenses and increasing income. Step 2, convert surplus into assets automatically. You set auto-investing, weekly or monthly, even small, because small, consistent investing beats big emotional investing. Step 3, grow your skill-based income. Pick a lane that has demand and pays well. Sales, analytics, operations, finance, tech-adjacent roles, project management, healthcare skills. Something. Then add consistent learning, even 3 hours a week. The goal is not perfection, it's compounding. Premiumization is about companies focusing on high-value customers. Your personal premiumization is about becoming high value in the labor market. That's how you escape the squeeze lane. Here's a filter you can use going forward. Whenever you read a business headline, ask: 1. Are they raising prices? Why? 2. Are customers accepting it or resisting? 3. Are they improving customer experience or just charging more? 4. Are they targeting a higher income segment? 5. Are they investing in perks, service, or brand? 6. Is customer growth slowing while quality improves? 7. What does that imply about the economy? This filter turns random headlines into an investing framework. Example: if you hear airline premium revenue up, that's premiumization. If you hear luxury retail strong, mid-tier weak, that's premiumization. If you hear subscription tiers push users to premium, that's premiumization. And when you connect enough of these signals, you build a clearer view of the economy than most people who just watch headlines.
Now, for your channel specifically, here's how to frame this for high RPM and sponsor safety. You're not saying, the economy is collapsing, or everything is rigged. You're saying, we're in a segmented economy where different households experience different realities. The premium segment is driving a lot of spending and corporate earnings, so let's build a plan that protects your downside and builds ownership upside. That's advertiser-friendly. That's evergreen. That's valuable. Sponsors like calm, intelligent framing, practical solutions, long-term mindset, not panic. So the story arc for this block is perfect. 1. Premiumization is happening. 2. Pricing power is the core advantage. 3. You invest it safely with a system. 4. You apply it to your personal wealth plan. That's the blueprint.
Let me give you a short story you can read slowly to keep viewers locked. Imagine 2 neighbors. Neighbor A has a stable job, invests monthly, and owns assets. When prices rise, they feel it. But it doesn't crush them. They still travel. They still dine out. They still upgrade. They feel like life is expensive, but manageable. Neighbor B has variable income, debt, and no buffer. When prices rise, everything becomes fragile. A car repair becomes a crisis. A rate increase becomes a problem. They cut spending, feel stress, and delay goals. Now, companies look at these two neighbors and decide, which one is the better customer? They chase neighbor A. That's premiumization.
Your mission is not to hate neighbor A. Your mission is to become more like neighbor A over time. Buffer, surplus, assets, stability, ownership.
Because ownership changes your relationship with inflation, rates, and cycles. Let's bring it home. Premiumization is not just a trend. It's a map of where profits are going, and pricing power is the force that keeps companies strong during uncertain periods. So, as an investor, you build broad exposure, you tilt toward quality, you don't gamble on one stock, and you stay consistent. As a wealth builder, you build a cash buffer, you eliminate toxic debt, you invest automatically, and you grow skills that increase your surplus. That's how you climb into the premium lane without needing luck. Next block, we're getting data-driven. We're breaking down the two-speed consumer using auxiliary credit stress indicators, delinquency trends, household debt trends, and what those signals mean for your money decisions right now. Because the best investors don't just understand stories, they understand the scoreboard. If you want this as a series, subscribe. And if you want partnerships or sponsorships, my business email is daniloencarnacion@gmail.com. Educational only, not financial advice. Alright, blocks 1 through 3 were the story. American Express is a window into the premium lane of the economy. Premiumization is real, pricing power matters, and you invest it safely through a system, not gambling. Now in this block, we're doing something most YouTube channels never do. We're going to stop arguing about vibes and start watching the scoreboard, because the reason people get confused about the economy is simple. They confuse headlines with reality, and they confuse the average person with where the marginal dollar is. So I'm going to show you the numbers that explain why. Some people feel squeezed, while premium spending stays strong, and why the market can look okay even when a lot of households feel stressed. And once you understand this data, you stop being shocked by the news. You stop getting emotional whiplash. You start thinking like a calm investor. Let's start with the simplest truth. The economy is not one thing. It's millions of households living different financial realities. One household has stable income, fixed-rate mortgage, savings, and assets like retirement accounts. Another household has variable income, high rent, credit card balances, and no buffer. Those two households can be in the same city, shop at the same stores, and live in totally different economies. That's why two people can look at the same year and say, this is the worst economy ever, and this is a great economy. Both can be telling the truth from their lane. So when we say two-speed economy, we're not trying to sound fancy. We're describing segmentation, and segmentation shows up in the data. I want to give you a dashboard you can use forever, not 50 indicators, 5. This is the scoreboard for the consumer economy. Metric number 1, credit card delinquency rate. Metric number 2, household debt delinquency share, all types. Metric number 3, spending concentration, who is driving spend. Metric number 4, category mix, premium versus essentials. Metric number 5, corporate guidance tone, what companies expect next. If you track these 5 calmly, you become immune to doom scrolling, because you'll know whether conditions are tightening or loosening. Now we're going to walk through each one. Let's start with our first metric, credit card delinquency rates. Of all the numbers we could watch, this is one of the most sensitive because credit cards are often the first place financial stress shows up in the data. Before a mortgage payment is missed, before a car is repossessed, a credit card payment is often the first to slip. Why? Because credit cards are uniquely flexible. For many, they are a tool of convenience, a way to earn rewards or smooth out small timing gaps between paychecks, with the balance paid in full each month. But when the broader economy gets tight, or a household's personal cash flow is squeezed, that revolving line of credit can transform from a convenience into a crucial survival tool. It's used for groceries, for gas, for utilities, the absolute essentials. This is when balances start to grow and minimum payments become harder to meet. So, the delinquency rate acts like a pressure gauge for the health of the consumer. Officially, a loan is considered delinquent when it is 30 days or more past due. The rates we're looking at typically track loans that are 90 days or more past due, which signals more persistent trouble. Looking at the data, the delinquency rate on credit card loans at all commercial banks was around 2.98% in the third quarter of 2025. That's actually slightly down from the first half of the year, which hovered just above 3%. Now, it's crucial to put that number in context. Don't panic at the number itself. Instead, think directionally and historically. For perspective, during the 2008 financial crisis, this rate soared to nearly 7%. A rate under 2.5% is generally considered healthy, a sign of a strong consumer. So a rate around 3% is not an end-of-the-world crisis. But it's also not a sign that everything is perfect either. It's a yellow light. It tells us that there is stress in the system, and it's present enough to be clearly measurable. But here's the most important insight. An average rate, even one that is stable or slightly improving, does not mean every household is fine. National data is an average of millions of different stories. It means that, on average, the system is functioning, but the pain is unevenly distributed. This is the core of the two-speed economy we've been talking about. This is exactly how you can see premium spending on travel and luxury goods remain strong, while at the same time, some households are struggling to afford basic necessities. The premium lane of the economy can stay smooth, while the squeezed lane feels like it's full of potholes. Higher-income households may be paying off their cards every month, keeping the average delinquency rate from skyrocketing, while lower-income households are falling further behind. So as an investor, your job isn't to pick a side and scream everything is great or everything is terrible. Your job is to interpret the scoreboard with nuance. And right now, the scoreboard says, consumer credit stress exists. It's concentrated in specific segments of the population. But at this point in the data, the system as a whole is not flashing red alert. The signal is more like, watch carefully. The trend from here matters more than any single number. Is this slight dip a temporary blip, or the start of a real improvement, or will the pressure build and the rate begin to climb again? That's what we need to monitor. Now let's go deeper and look at our second metric, which gives us a wider view of the same landscape. While rising credit card delinquencies can feel like a flashing warning light on the dashboard, it's crucial to remember they are just one part of a much larger engine. To truly understand the health of the consumer, we need to zoom out and look at the entire landscape of household debt. This includes not just the high-interest, revolving debt from credit cards, but the foundational pillars of household finance. Mortgages, which represent the largest single component for most families. Auto loans, a necessity for transportation in much of the country. Student loans, a significant burden for millions. And other forms of consumer credit. Each of these tells a different story about financial stability and stress. That's where the New York Fed's quarterly report on household debt and credit becomes an indispensable tool. It's one of the most comprehensive data sources available, giving us a reliable, economy-wide view of both household balances, the total amount owed, and the share of that debt that is falling into delinquency. Think of it as a regular health checkup for the American consumer's balance sheet. It helps us cut through the noise of daily headlines and focus on the underlying trends. Looking at the data for Q3 2025, we see that total household debt rose to a new nominal high of around $18.6 trillion. Now, it's important to contextualize this number. On its own, a rising debt level isn't necessarily a sign of trouble. In an expanding economy with a growing population and rising asset values, you'd expect this figure to climb. The more critical question is about the quality of that debt. And for that, we look at the delinquency share. In the same quarter, the share of outstanding debt in some stage of delinquency was around 4.5%. That figure was largely flat, ticking up only slightly compared to the prior quarter. So, what does this tell us? It suggests that while financial pressures are building in some areas, we are not seeing a widespread systemic breakdown in the ability of households to service their debts. The situation is deteriorating, but slowly. It's not apocalyptic, but it's certainly not nothing. Now here's where the nuance is critical. These aggregate numbers mask a deep divide in the American consumer experience. A huge portion of that household debt, the majority in fact, is mortgage debt. And in the US, most of that is locked in at fixed rates. For the millions of homeowners who refinanced or bought when rates were at historic lows, their largest monthly payment is insulated from inflation and rising interest rates. They might feel the pinch at the grocery store, but their housing cost is stable. Meanwhile, the story is completely different for renters, who face soaring housing costs, and for any household that relies on variable rate or short-term borrowing. This is where the pain is concentrated. Credit card balances, personal loans, and adjustable rate mortgages directly expose these consumers to the Federal Reserve's rate hikes. Their borrowing costs are actively increasing, squeezing their budgets month after month. This creates the two-speed or bifurcated economy we've been discussing. On one track, you have homeowners with fixed-rate debt who feel relatively protected and financially secure. On the other, you have renters and consumers with high-interest revolving debt who feel intensely squeezed. This isn't just a vibe or a feeling. The New York Fed's data shows us it's a structural reality of our economy today. And investors pay very close attention to structural realities because they have lasting power. They don't just affect one quarter's earnings. They shape consumer demand, corporate strategy, and market performance for years to come. Now let's bring this back to the premiumization theme. If a company's target customers are mostly high-income households, those individuals are far more likely to be homeowners on the stable, protected side of that economic split. Their capacity to spend on premium goods and services remains largely intact. This structural divide is a key reason why a company like American Express can report resilient spending and low default rates among its card members, even as broader data shows signs of consumer stress. Their customer base is, by design, positioned on the more stable track of this two-speed economy. Understanding this household debt dynamic is fundamental to seeing which businesses are built to weather the storm and which are most exposed. Now, this part is critical. Most people talk about the consumer like it's one person, but spending is not evenly distributed. High-income households drive a disproportionate share of total spending, and in recent years, that share has increased. Here's one way to see it. A Dallas Fed analysis noted that the share of spending by the top 20% of the income distribution has risen over the last few decades, from about 53% to around 57%. That matters because if the top segment keeps spending, the economy can look okay in aggregate even if the bottom segments are stressed. And there are also private sector signals showing that high-income households' share of spending can jump in key periods like holidays. For example, PwC reported that high-income households' share of holiday spend increased notably in 2025 compared to 2024, while middle and low-income shares fell. Now listen, this isn't about judging anyone. This is about understanding the machine. If the economy is increasingly supported by the spending of the top segment, then businesses that serve that segment can remain strong, and markets can remain supported, even while many households feel squeezed. That's why you get disconnect moments. Stock indexes look healthy, airports are busy, premium brands are strong, yet many households say they're struggling. These are not contradictions, they're distribution. Now let's add another layer, category mix. Here's a quick rule. The economy tells the truth through what people spend on. When people feel confident and liquid, they spend on travel, dining, entertainment, premium retail, experiences. When people feel stressed, they focus on essentials, trade-down brands, fewer discretionary purchases, more buy now, pay later, or revolving credit behavior. So when Amex says spending was strong across travel, dining, retail, and luxury during the holiday season, that's a premium category signal. But if you look at broader consumer behavior, you can also see trade-down behavior in other parts of the market. Some households shift to discount retailers, reduce restaurant frequency, delay major purchases, or use credit more heavily. This is where the two-speed economy becomes visible. Not everyone is cutting back at the same time and not in the same categories. So here's the investor question. Which companies have customers still spending in premium categories? And which companies have customers that are forced to cut back? Because those two company types will behave differently in earnings season. That's why premiumization is so powerful for companies. It's a defense mechanism against the squeezed middle. But again, premiumization has risk. If the premium segment slows, the defense weakens. So you don't just watch premium spending, you watch the whole scoreboard. Now let's talk about the last and most important metric. This is the part that people ignore. Guidance tone. Companies tell you what they see in real time. Amex guided to strong earnings per share for 2026 and said spending by affluent and younger consumers remains resilient. That is a forward-looking statement, not just a summary of the past. It's management telling you, what we're seeing so far suggests the premium customer remains intact. Now, does that mean everything will be perfect? No. But it tells you what the base case looks like from their vantage point. And here's the pro move. You compare guidance tone across sectors. If premium brands are confident, travel companies are confident, but mass market retailers are cautious. That's segmentation. If everyone becomes cautious at once, that's a different signal. So if you want to track the economy without losing your mind, listen to what companies say about their customer base, demand trends, and credit quality. That's real-time intelligence. Let's summarize what the data is telling us. 1. Credit card delinquencies around 3% suggest stress exists, but the system is functioning. 2. Household debt keeps rising, and delinquency share around 4.5% suggests broad delinquency remains elevated, but stable-ish. 3. Spending is increasingly concentrated among high-income households. 4. Premium categories can remain strong while other households cut back. 5. Corporate guidance from premium-exposed companies can remain upbeat even when broader sentiment feels weak. That is exactly what a two-speed economy looks like. Now the big question, what do you do with that? Because information without action is just entertainment. And this channel is about building wealth, not collecting facts. So now we turn the scoreboard into a plan. To navigate this economic landscape, you need a personal plan. Think of it like building a house. You wouldn't start with the roof. You'd begin with a solid foundation. Your financial plan is no different. It has two essential layers, each serving a critical purpose. Layer A is your foundation. Protect your downside. This is about building financial resilience, creating a shield against unexpected shocks so you can operate from a position of stability, not panic. Layer B is the structure you build upon that foundation. Position for upside ownership. This is about strategically capturing the growth opportunities that arise, ensuring you're not just surviving, but thriving over the long term. Let's go layer by layer, starting with the most important part, your financial foundation. Step 1. Build a buffer. This is your first line of defense. The immediate goal is simple. Get a small amount of cash set aside for minor emergencies. Even a $500 buffer can dramatically reduce financial stress, preventing a small car repair or medical bill from becoming a major crisis. Once you have that initial cushion, you build toward a larger goal. 1 month of essential living expenses, then 3 months, and eventually 6 months, depending on your personal situation and risk tolerance. A freelancer might aim for a larger buffer than someone with a very stable dual-income household. Why is this so critical? Because in a segmented economy, financial shocks hit people unevenly. A layoff in one sector, a sudden rise in costs. These events don't affect everyone the same way. Your buffer isn't just money, it's a strategic asset. It buys you time to find the right job, not just any job. It gives you the option to negotiate, to wait for a better opportunity, or to handle a crisis without derailing your entire financial life. Step 2. Control high-interest debt. If your buffer is your shield, high-interest debt is a crack in that shield. If you have credit card debt at a high APR, you are effectively paying a negative return every single month. That interest is working against you, making it harder to save, invest, or get ahead. Paying down that debt is often the best guaranteed return you can possibly get. A 22% APR on a credit card is a 22% guaranteed return for your future self when you pay it off. So you use a simple, methodical ladder approach. First, set up autopay for the minimum payments on all your debts. This prevents missed payments and late fees. Second, pick one debt to attack, either the one with the highest interest rate, which is the most mathematically efficient, or the smallest balance, which can provide a powerful psychological win. Finally, once that debt is paid off, you roll that entire payment amount forward onto your next target. This creates a snowball effect, accelerating your progress. Step 3. Build a bills system. With your buffer started and a debt plan in motion, it's time to organize your cash flow. You separate your money into distinct categories, either physically or digitally. One account or folder is for fixed bills, rent, utilities, insurance. Another is for flexible spending, groceries, gas, entertainment. And a third is for wealth, your savings, debt payoff, and investments. This simple act of separation reduces chaos and dramatically improves consistency. You always know your bills are covered. When finances feel chaotic and jumbled in one big account, people tend to make poor, short-sighted decisions. Organization isn't just about being neat, it's a fundamental wealth skill that enables clarity and control. Step 4. Keep your credit clean. In a world where credit risk matters more than ever, your credit score is a key financial tool. It directly affects the interest rates you're offered on loans, your insurance pricing in many areas, your housing options, as landlords check credit, and it can even impact some job opportunities, especially in finance. The rules for maintaining it are straightforward. First, never ever miss a payment. This is the single most important factor. Second, keep your credit utilization low if possible, ideally below 30% of your available limit. And third, avoid unnecessary hard inquiries. Only apply for credit when you actually need it. This isn't about chasing a status symbol. This is about building and protecting your financial leverage. A good credit score is a key that unlocks better terms and more opportunities. Now, with that protective layer in place, we can move to layer B, positioning for upside. Step 1. Automate ownership. You build an auto-invest plan that you can comfortably afford. The amount is less important than the action. Even if it's just $25 a week, even if it's only $50 a month, you are building the habit of paying yourself first. Consistency matters far more than intensity, especially in the beginning. Because the two-speed economy disproportionately rewards asset owners over time, automation ensures you are consistently, methodically, becoming one. Step 2. Tilt toward quality, not hype. If you want exposure to the premiumization trend we've discussed, you can tilt your portfolio toward quality businesses broadly through diversified funds or ETFs. You do not need to gamble on one specific stock or try to predict the next big thing. That's speculation, not investing. Quality characteristics are what you look for in the underlying businesses. These often include strong, defensible profit margins, strong balance sheets with manageable debt, durable demand for their products or services, pricing power, the ability to raise prices without losing customers, and consistent, predictable cash flows. Step 3. Grow your income through skill stacking. Ultimately, your ability to invest is limited by your surplus, the gap between your income and your expenses. And the most powerful way to grow that surplus is to grow your income while keeping your expenses controlled. So you choose a lane with durable demand and you commit to getting better. This could be sales or communication, data analytics, operations and logistics, project management, tech-adjacent skills like digital marketing, in-demand healthcare roles, or skilled trades with strong, localized demand. Then you compound that skill slowly and deliberately, just like your investments. The goal is not to get rich quick. The goal is to become harder to replace, more valuable to your employer or your clients. Because pricing power is not just for companies, it's for people too. Your skills, your reputation, and your reliability give you leverage to command a higher income over your career. That is the ultimate engine of wealth creation. Let me give you a monthly routine that fits a normal life. Once a month, 30 minutes. 1. Check cash buffer. Did it grow? 2. Check debt. Did balances fall? 3. Check investing. Did contributions happen automatically? 4. Check spending. Any leaks you can fix. 5. Check scoreboard, delinquency trend, debt trend, and corporate guidance vibe. That's it. You don't need to stare at charts every day. You need a system. Most people lose money because they do too much emotionally. Wealth is built by doing a few things repeatedly and calmly. I want to give you a story that matches the data. Neighbor A. Stable job. Fixed rate mortgage. Invests monthly. Has a buffer. Neighbor B. Variable income. Rents. Uses credit cards to bridge gaps. No buffer. Now interest rates rise and costs rise. Neighbor A feels it, but can adapt. Their housing payment is stable. They still invest. Their assets might rise over time. They can still travel sometimes. Neighbor B feels it immediately. Rent rises. Minimum payments rise. They cut spending. They fall behind. Delinquencies increase. Now look back at the data. Delinquency rates exist. Debt keeps rising. Spending concentrates at the top. That's the story in numbers. And if you are neighbor B right now, that is not a life sentence. It's a starting point. Your mission is to move step by step toward the owner lane. Buffer, debt control, automated investing, skills, surplus, assets. For the next 90 days, here's what matters. 1. Do delinquency rates trend higher or stabilize? 2. Does household delinquency share rise meaningfully? 3. Do premium category companies keep giving strong guidance? 4. Does spending concentration increase further? 5. Do we see broad-based weakness or just continued segmentation? You're not trying to predict every move. You're trying to understand the direction, because direction helps you stay calm and consistent. And consistent is how you win. If you want this to be high RPM and sponsor safe, your framing is, the economy is segmented. Different households experience different realities. Premium spending signals are still strong. Credit stress exists, but it's uneven. So here's the plan. Protect yourself and build ownership. Sponsors like that. It's practical. It's not panic. It's not controversial. You're teaching financial literacy and systems. And that's evergreen. In Block 5, we're going to go deeper into the ecosystem. Payments versus lenders. Amex versus Visa versus MasterCard. Why these businesses behave differently in different economic climates, and how you choose exposure without guessing. Because once you understand that ecosystem, you stop being confused by why one stock moves and another doesn't. If you're still here, comment one thing. Which lane are you in right now? Squeezed lane or premium lane? And what's one move you'll make in the next 30 days? Buffer, debt payoff, auto investing, or skill building? Business inquiries. Your business email. Educational only, not financial advice.
All right. Blocks 1 through 3 were the story. American Express is a window into the premium lane of the economy. Premiumization is real, pricing power matters, and you invest it safely through a system, not gambling. Now in this block, we're doing something most YouTube channels never do. We're going to stop arguing about vibes and start watching the scoreboard. Because the reason people get confused about the economy is simple. They confuse headlines with reality, and they confuse the average person with where the marginal dollar is. So I'm going to show you the numbers that explain why. Some people feel squeezed, while premium spending stays strong, and why the market can look okay even when a lot of households feel stressed. And once you understand this data, you stop being shocked by the news. You stop getting emotional whiplash. You start thinking like a calm investor. Let's start with the simplest truth. The economy is not one thing, it's millions of households living different financial realities. One household has stable income, fixed-rate mortgage, savings, and assets like retirement accounts. Another household has variable income, high rent, credit card balances, and no buffer. Those two households can be in the same city, shop at the same stores, and live in totally different economies. That's why two people can look at the same year and say, this is the worst economy ever, and this is a great economy. Both can be telling the truth from their lane. So when we say two-speed economy, we're not trying to sound fancy. We're describing segmentation, and segmentation shows up in the data. I want to give you a dashboard you can use forever, not 50 indicators. 5. This is the scoreboard for the consumer economy. Metric number 1, credit card delinquency rate. Metric number 2, household debt delinquency share, all types. Metric number 3, spending concentration, who's driving spend. Metric 4, category mix, premium versus essentials. Metric number 5, corporate guidance tone, what companies expect next. If you track these 5 calmly, you become immune to doom scrolling, because you'll know whether conditions are tightening or loosening. Now we're going to walk through each one. Let's start with our first metric, credit card delinquency rates. Of all the numbers we could watch, this is one of the most sensitive leading indicators of consumer health. Think of it as the canary in the coal mine for household finances, because credit cards are often the first place financial stress begins to show up. Before a mortgage payment is missed, before a car loan goes into default, a credit card payment is often the first to be late. Why they're first? Because credit cards are uniquely flexible. In good times, people use them for convenience, to smooth out monthly spending, or to collect rewards and travel points. That's healthy, strategic use. But when household cash flow gets tight, maybe due to a job loss, reduced hours, or rising living costs, that same piece of plastic transforms. Revolving balances where you carry debt from one month to the next stop being about convenience and can become essential survival tools. They bridge the gap between income and expenses. So, the delinquency rate, the percentage of loans that are 30 days or more past due, acts like a pressure gauge for the entire consumer economy. It tells us how many people are struggling to keep up. So, what is the gauge telling us right now? According to data from the Federal Reserve, the delinquency rate on credit card loans at all commercial banks was around 2.98% in the third quarter of 2025. That's a slight dip from the first half of the year, where it hovered just above 3%. Now, to understand what that number really means, we need context. During the 2008 financial crisis, this rate spiked to nearly 7%. Conversely, during the pandemic stimulus era, it fell to a historic low of around 1.5%. The long-term historical average sits closer to 2.5%. So, don't panic at the number itself. A single data point is just a snapshot. Instead, think directionally. The key is the trend over time. Our current rate of just under 3% is above the historical average, but well below a crisis level. A delinquency rate around 3% is not the end of the world. But it's certainly not everything is perfect, either. It's a clear, unambiguous signal that there is stress in the system, and it's present enough to be measurable and meaningful. It tells us that a significant number of households are finding it difficult to manage their debts. But here's the most important key to interpreting this metric. Even if the overall delinquency rate is stable or even slightly improving, that does not mean every household is fine. An average can be deceiving. It means that on the whole, the system is absorbing the pressure without breaking. But the pain is not distributed evenly. This is exactly how you can see premium spending on luxury goods and travel remains strong, while at the same time, a growing number of households are struggling to afford basic necessities. The premium lane on the economic highway can stay smooth and clear, while the squeezed lane feels like it's full of potholes and traffic jams. So, as an investor, your job isn't to join a chorus screaming everything is great or everything is terrible. Your job is to read and interpret the scoreboard with nuance. And right now, the scoreboard says, consumer credit stress absolutely exists. It's a real headwind for a portion of the population. But at this point in the data, it's not flashing a red alert for the entire system. It's more of a persistent, yellow watch carefully signal. The trend from here matters more than any single number we've discussed. Is this the peak of the pressure, or are we just getting started? That's the question we need to keep asking. Now let's go deeper and look at our second metric, which gives us another critical piece of the puzzle. While credit card delinquencies offer a sharp, real-time signal, they're just one piece of a much larger puzzle. To truly understand the health of the consumer, we need to zoom out and look at the complete picture of household debt. This includes everything from long-term commitments like mortgages to medium-term financing for auto loans and student loans, and of course, short-term revolving debt like credit cards and other consumer credit lines. Each of these categories tells a different story about consumer behavior and financial stability. Focusing on just one can give you a distorted view, like trying to understand an entire orchestra by only listening to the violins. That's where the New York Fed's quarterly household debt and credit report becomes an indispensable tool. It's considered the gold standard for this kind of analysis because it's not based on surveys or estimates. It's built on a large, nationally representative and anonymous sample of actual consumer credit data. This report gives us a reliable, economy-wide view of two critical metrics: total household balances, that's the total amount of debt people are carrying, and the delinquency share, which is the percentage of that debt that is overdue. Looking at the data for Q3 2025, we see that total household debt continued its upward climb, rising to a new nominal high of around $18.6 trillion. To put that number in perspective, it's a significant increase from the roughly $14 trillion seen just before 2020. At the same time, the share of that outstanding debt in some stage of delinquency, meaning at least 30 days past due, was around 4.5%. That delinquency share was largely flat, ticking up only slightly compared to the prior quarter, and it remains below the levels we saw during the 2008 financial crisis. Now, here's why this matters. The report paints a picture of nuance. On one hand, the steady, gradual rise in total debt isn't by itself a red flag. It often grows alongside the economy. On the other hand, the fact that a meaningful slice of that debt is in delinquency tells us that a segment of the population is struggling to keep up. So, the situation is not apocalyptic, but it's certainly not nothing. It's a signal of growing financial pressure that isn't yet at a systemic crisis level. Now let's dig into the critical nuance within these numbers. A huge portion of that $18.6 trillion in debt is in mortgages, and the vast majority of mortgage debt in the U.S. is fixed rate. This is a powerful stabilizing force. Millions of households locked in historically low mortgage rates before 2022. While they certainly feel the pinch of inflation on groceries and gas, their single largest monthly expense, their housing payment, doesn't jump. This financial cushion is incredibly important. Meanwhile, it's a completely different story for renters, who face rising lease renewals, and for households with significant variable rate exposure. This includes anyone carrying a balance on credit cards, using a home equity line of credit, or relying on other forms of short-term borrowing. For them, higher interest rates aren't an abstract concept. They translate directly into higher monthly payments and increased financial pressure. This creates a clear and widening divergence in the economy. On one side, you have homeowners with fixed-rate debt who feel relatively protected and financially secure. On the other, you have renters and consumers with high-interest revolving debt who feel increasingly squeezed by the combination of inflation and higher borrowing costs. That's a two-speed economy in its purest form. So the New York Fed numbers help you understand that what people are feeling isn't just a vibe or a matter of personal outlook. It's a structural reality rooted in the different types of financial obligations people have. And investors care deeply about these structural realities because they don't just affect the next quarter, they shape consumer demand, corporate strategy, and market performance for years to come. Now let's bring this back to our central theme of premiumization. If a company's target customers are mostly high-income households, those individuals are far more likely to be homeowners with stable, fixed-rate debt. They are on the more resilient side of that economic split. Their capacity for discretionary spending, while not infinite, is far less impacted by rising interest rates. This structural divide is a key reason why a company like American Express can report resilient spending and low default rates among its cardholders, even while broader data shows signs of consumer stress. Their customer base is heavily skewed toward that more protected, high-income demographic, insulating them from the pressures felt elsewhere in the economy. Now, this part is critical. Most people talk about the consumer like it's one person, but spending is not evenly distributed. high-income households drive a disproportionate share of total spending, and in recent years, that share has increased. Here's one way to see it. A Dallas Fed analysis noted that the share of spending by the top 20% of the income distribution has risen over the last few decades, from about 53% to around 57%. That matters because if the top segment keeps spending, the economy can look okay, in aggregate, even if the bottom segments are stressed. And there are also private sector signals showing that high-income households' share of spending can jump in key periods like holidays. For example, PwC reported that high-income households' share of holiday spend increased notably in 2025 compared to 2024, while middle and low-income shares fell. Now listen, this isn't about judging anyone. This is about understanding the machine. If the economy is increasingly supported by the spending of the top segment, then businesses that serve that segment can remain strong, and markets can remain supported, even while many households feel squeezed. That's why you get disconnect moments. Stock indexes look healthy, airports are busy, premium brands are strong, yet many households say they're struggling. These are not contradictions, they're distribution. Aggregate data can be supported by concentrated spending. Now let's add another layer: category mix. Here's a quick rule: the economy tells the truth through what people spend on. When people feel confident and liquid, they spend on travel, dining, entertainment, premium retail, experiences. When people feel stressed, they focus on essentials, trade-down brands, fewer discretionary purchases, and more buy now, pay later or revolving credit behavior. So when Amex says spending was strong across travel, dining, retail, and luxury during the holiday season, that's a premium category signal. But if you look at broader consumer behavior, you can also see trade-down behavior in other parts of the market. Some households shift to discount retailers, reduce restaurant frequency, delay major purchases, or use credit more heavily. This is where the two-speed economy becomes visible. Not everyone is cutting back at the same time, and not in the same categories. So here's the investor question: which companies have customers still spending in premium categories, and which companies have customers that are forced to cut back? Because those two company types will behave differently in earnings season. That's why premiumization is so powerful for companies. It's a defense mechanism against the squeezed middle. But again, premiumization has risk. If the premium segment slows, the defense weakens. So you don't just watch premium spending, you watch the whole scoreboard. Now let's talk about the last, and most important, metric. This is the part that people ignore: guidance tone. Companies tell you what they see in real time. Amex guided to strong earnings per share for 2026 and said spending by affluent and younger consumers remains resilient. That is a forward-looking statement, not just a summary of the past. It's management telling you, what we're seeing so far suggests the premium customer remains intact. Now, does that mean everything will be perfect? No, but it tells you what the base case looks like from their vantage point. And here's the pro move: you compare guidance tone across sectors. If premium brands are confident, travel companies are confident, but mass market retailers are cautious, that's segmentation. If everyone becomes cautious at once, that's a different signal. So if you want to track the economy without losing your mind, listen to what companies say about their customer base, demand trends, and credit quality. That's real-time intelligence. Let's summarize what the data is telling us. 1. Credit card delinquencies around 3% suggest stress exists, but the system is functioning. 2. Household debt keeps rising, and delinquency share around 4.5% suggests broad delinquency remains elevated but stable-ish. 3. Spending is increasingly concentrated among high-income households. 4. Premium categories can remain strong while other households cut back. 5. Corporate guidance from premium-exposed companies can remain upbeat even when broader sentiment feels weak. That is exactly what a two-speed economy looks like. Now the big question: what do you do with that? Because information without action is just entertainment. And this channel is about building wealth, not collecting facts. So now we turn the scoreboard into a plan. Now, let's translate this economic landscape into a personal strategy. This isn't about complex financial engineering, it's about building a resilient personal economy that can navigate the two-speed world we've discussed. Your plan has two fundamental layers, and they must be built in order. Layer DAR. A is about defense. You protect your downside. This is your foundation. It's what keeps a small setback from becoming a major crisis. Layer RB is about offense. You position for upside ownership. This is how you participate in the premium tier of the economy, even if your income isn't there yet. Let's go layer by layer, starting with the most critical. Step 1. Build a buffer. Before you do anything else, you need a cash reserve. We start small. Even a $500 buffer is a powerful psychological win. It's the difference between a surprise car repair being an inconvenience versus a full-blown emergency that forces you into high-interest debt. It breaks the cycle of living paycheck to paycheck. Once you have that initial $500, you don't stop. You build toward 1 month of essential living expenses, then 3 months. The ultimate goal for most is 6 months. The right amount depends on your situation. A dual-income household with stable jobs might feel comfortable with 3 months, while a freelancer or single-income family should aim for 6 or more. Why is this non-negotiable? Because in a segmented economy, shocks hit people unevenly. A layoff, a medical bill, a sudden rent increase. These events are manageable when you have a cushion. Your buffer buys you the 2 most valuable assets in a crisis: time and options. It gives you time to find the right job, not just any job. It gives you the option to negotiate, to plan, to breathe. Without it, you are forced to make decisions from a place of desperation, which almost always leads to poor outcomes. Step 2. Control high-interest debt. If you are carrying debt on credit cards with a high annual percentage rate, or APR, you are running a race with weights on your ankles. An 18%, 22%, or even 28% APR is a massive headwind. Financially, you are paying for a guaranteed negative return every single month. From a purely mathematical standpoint, paying down that debt is often the best guaranteed return you can possibly get. No stock market investment can promise you a guaranteed 22% return, but paying off a card with that interest rate does exactly that. The strategy here is simple and methodical. You use a debt ladder, sometimes called the avalanche method. First, you set up automatic payments for the minimum amount due on all of your debts. This prevents missed payments and protects your credit. Second, you take all your extra available cash and aggressively attack one target debt. Specifically, the one with the highest interest rate. Third, once that debt is paid off, you don't absorb that payment back into your lifestyle. You roll that entire payment, plus the minimum you were paying, forward onto the next debt in line. This creates a snowball of cash flow that accelerates your progress. Step 3. Build a bills system. The feeling of financial chaos is a major source of stress and bad decisions. To combat this, you need a system. The simplest effective method is to separate your money into 3 distinct buckets as soon as you get paid: one for bills, one for guilt-free spending, and one for wealth creation. This can be done with separate checking or savings accounts. The bills account holds all the money for your fixed costs like rent, utilities, and debt payments. The spending account is for variable costs like groceries, gas, and entertainment. The wealth account is for your buffer and investments. This separation reduces chaos and improves consistency because you always know exactly what your money's job is. When finances feel chaotic, people tend to either freeze and do nothing, or make impulsive, emotional decisions. By creating this structure, you are imposing order. You are building a process that runs on autopilot, freeing up your mental energy for more important things. Organization is a wealth skill. Step 4. Keep your credit clean. In a world where credit risk matters more than ever, your credit score is a key piece of your financial infrastructure. It directly affects the interest rates you'll be offered on mortgages and car loans, the pricing you get on insurance, your access to the best housing options, and in some fields, even your job opportunities. The rules are simple. First, never miss a payment. This is the single biggest factor. Second, keep your credit utilization low if possible. That's the percentage of your available credit that you're using. Aim for below 30%. Third, avoid unnecessary hard inquiries by only applying for credit when you truly need it. This is not about status. This is about building and protecting your financial leverage. A good credit score is a tool that saves you tens or even hundreds of thousands of dollars over a lifetime. Now we shift to layer B, position. With your foundation secure, you can start building for the upside. Step 1. Automate ownership. The single most effective way to build wealth is to become an owner of assets. You do this by building an auto-invest plan you can afford. It doesn't have to be a huge amount. Even if it's $25 a week, Even if it's just $50 a month to start, you set up an automatic transfer from your bank account into a low-cost investment account on the same day every month. This is called dollar cost averaging. The key is that it's automatic and consistent. Consistency matters far more than intensity. Why does this work? Because the two-speed economy, over the long term, consistently rewards asset owners. While wages can stagnate, the value of productive assets, like shares in quality companies, tends to grow. Automation removes emotion and ensures you are always making progress. Step 2. Tilt toward quality, not hype. The goal is not to find the next lottery ticket stock. If you want exposure to the premiumization trend, you can tilt your portfolio toward quality businesses broadly. These are the durable market-leading companies that serve the premium tier of the economy. You do not need to gamble on one stock. You can own them through broad, low-cost index funds or ETFs that give you diversified exposure. What defines a quality business? The characteristics are consistent and observable. They often include strong and stable profit margins, strong balance sheets with manageable debt, durable demand for their products or services that persist through economic cycles, significant pricing power, allowing them to pass on costs, and most importantly, consistent and predictable cash flows. These are the hallmarks of resilience. Step 3. Grow your income through skill stacking. Your ability to invest is ultimately limited by your surplus, the money left over after your income covers your expenses. The most powerful way to grow that surplus is to grow your income. You do this by systematically stacking valuable skills. You don't need to become a world expert overnight. You choose a durable lane with strong demand, such as sales, data analytics, operations, project management, tech-adjacent skills like cybersecurity, or essential services like healthcare and skilled trades. Then you commit to getting 1% better every week. You take a certification, you lead a small project, you learn a new piece of software, you compound your human capital slowly and deliberately. The goal is not to get rich quick. The goal is to become harder to replace. In a segmented economy, the most valuable professionals are those who can solve complex problems or serve the needs of the premium tier. By stacking skills, you increase your value to the marketplace. This brings us back to a key theme. Pricing power is not just for companies, it's for people. When you have rare and valuable skills, you have more leverage to command a higher salary, better benefits, and more autonomy in your work. You build your own personal premium tier. Let me give you a monthly routine that fits a normal life. Once a month, 30 minutes. 1. Check cash buffer. Did it grow? 2. Check debt. Did balances fall? 3. Check investing. Did contributions happen automatically? 4. Check spending. Any leaks you can fix. 5. Check scoreboard. Delinquency, trend, debt trend, and corporate guidance vibe. That's it. You don't need to stare at charts every day. You need a system. Most people lose money because they do too much emotionally. Wealth is built by doing a few things repeatedly and calmly. I want to give you a story that matches the data. Neighbor A, stable job, fixed rate mortgage, invests monthly, has a buffer. Neighbor B, variable income, rents, uses credit cards to bridge gaps, no buffer. Now interest rates rise and costs rise. Neighbor A feels it but can adapt. Their housing payment is stable. They still invest. Their assets might rise over time. They can still travel sometimes. Neighbor B feels it immediately. Rent rises. Minimum payments rise. They cut spending. They fall behind. Delinquencies increase. Now look back at the data. Delinquency rates exist. Debt keeps rising. Spending concentrates at the top. That's the story in numbers. And if you are neighbor B right now, that is not a life sentence. It's a starting point. Your mission is to move step by step toward the owner lane. Buffer, debt control, automated investing, skills, surplus, assets. For the next 90 days, here's what matters. 1. Do delinquency rates trend higher or stabilize? 2. Does household delinquency share rise meaningfully? 3. Do premium category companies keep giving strong guidance? 4. Does spending concentration increase further? 5. Do we see broad-based weakness, or just continued segmentation? You're not trying to predict every move. You're trying to understand the direction, because direction helps you stay calm and consistent is how you win. If you want this to be high RPM and sponsor safe, your framing is, the economy is segmented. Different households experience different realities. Premium spending signals are still strong. Credit stress exists, but it's uneven. So here's the plan. Protect yourself and build ownership, sponsors like that. It's practical, it's not panic, it's not controversial. You're teaching financial literacy and systems, and that's evergreen. In Block 5, we're going to go deeper into the ecosystem, payments versus lenders, Amex versus Visa versus MasterCard, why these businesses behave differently in different economic climates, and how you choose exposure without guessing. Because once you understand that ecosystem, you stop being confused by why one stock moves and another doesn't. If you're still here, comment one thing. Which lane are you in right now? Squeezed lane or premium lane? And what's one move you'll make in the next 30 days? Buffer, debt payoff, auto investing, or skill building? Business inquiries. Danilo, Encarnacion. gmail.com. Educational only, not financial advice.